Here we go again, live from New York City this morning. Good morning, good morning. For our audience worldwide, equities lower. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, we begin with the big issue confronting a growth scare.
We've seen the beginnings of a growth scare.
We have a fragile global recovery.
It's going to take time for inflation to come down.
An 18% increase in airfares, after 10%, after 5%, after 2%.
What we're seeing is the shift between goods and service inflation.
This is outrageous.
We're going to have to see the Fed react.
50 basis points in June, another 50 basis points in July.
And we're going to have to see higher inflation prints before the Fed reacts.
When we step back and look at the whole picture,
We're fighting an inflation battle on two fronts.
Demand is clearly a driver.
On the other hand, we have continued limitations of supply.
You also have a growth scare happening.
A stronger slowdown in growth.
There's a lot of conflicting signals.
Joining us now to discuss SocGen, Subadra, Rajappa, Crossmark's Bob Dole. Subadra, you called 325 on a 10-year in America earlier this week, 320. Since then, 4 straight days, yields lower, yields lower, yields lower, yields lower. Subadra, what does that move tell you?
So finally, I think that the stock-bond correlation is starting to fall apart, which I think should stabilize the market somewhat here, given the fact that we've seen this extraordinary run-up in bond yields, and the market's basically pushing back on the bearish sentiment, broadly speaking. I think, even getting to 325 for us felt like a little bit of an overshoot, and we mentioned that in our research reports that we could overshoot to 325, and now you're starting to see this reversal and this rush to short cover as the market starts to express concerns over growth for the remainder of the year. So, to me, this is, really the market pushing back on a sustained sell-off in bonds, given the macroeconomic backdrop.
Bob Dole, can you take any comfort from that?
Yeah, I can. I don't know how many weeks in a row I've written, John, that, stock market can't handle interest rates moving up at 15, 20, 25 basis points per week. The respite is one requirement for stocks to stabilize. Hopefully that's what we're watching now.
Let's go through some of these names. Netflix, year to date, down 72%. Facebook, down 44%. Amazon, down 37%. Tesla, down 30%. Microsoft, down almost 23%. Google, down about 21.6%. Apple, down almost 18%. That's before today. But out of those names, have you seen enough carnage yet to step back in?
So I've owned Microsoft all the way through. That's the one I'm riding. The others, I'm either underweight or short. Not sure that ball game is over. I'd rather own cheaper, old, give me the cash on the barrelhead, give me a yield tech stocks, Intel, Cisco, IBM, those kinds of names. I won't own them forever, but for now, I prefer that group to what you just put on the board.
Subadra, we've seen some real wealth destruction across some big names in the equity market, in crypto. We've seen mortgage costs climb as well. Do you think the Fed's seen enough yet? That's what a lot of people are grappling with. This Fed put in retirement, what on earth brings it back out?
Exactly what you're seeing, which is, a significant tightening of financial conditions. Mortgage rates going up quite dramatically. That's going to slow down the housing market. But as of now, at the current time at least, the employment picture is still pretty robust. So the Fed's going to kind of stay the course and deliver at least a couple of more 50 basis points rate hikes. But, it's going to really shift quite meaningfully as we approach September and beyond, because by then the Fed would feel like they've been able to front load rate hikes, and then they can kind of take a much more slower pace when it comes to raising rates. Demand destruction is something that they have to be paying attention to. Last year, they were, pretty much focused solely on employment. This year, they're pretty much solely focused on inflation. Towards the end of the year, I think that they're going to look at both parts of their dual mandate.
Subadra, when would you expect to see this in the economic data? A few months, several months? When would you expect to see it? Financial conditions right now are tightening. Market participants are anticipating it. When would you expect to see it?
I think that there's going to be a lag between, rate hikes and sort of the transmission into the broader economy Typically, those lags tend to be anywhere between 6 to 8 months. But as far as demand destruction is concerned and consumer sentiment is concerned, I think that could change very quickly. I mean, disposable income is starting to come under pressure because of higher commodity prices, higher oil prices, higher food prices. So you're going to see a retrenchment from the consumer a lot sooner than the transmission mechanism from higher interest rates.
25 minutes out from the open, and Bal equity futures down about 0.8%. Looking through the pain, the carnage, the destruction. Pick your word. Here's Abigail Doolittle.
John, it is a truly brutal environment for stock bulls and longs right now. The inflation fears are really weighing. It means that the floor keeps falling after an absolutely horrible April, the worst since March of 2020. Over the last 5 days, you have the futures for the S&P 500, the NASDAQ 100, and the Russell 2000 down, down, down. For the S&P 500 down 6%, down 5 out of the last 6 days. The NASDAQ 100 futures down 8%. Russell 2000 down 8.7%. So that right there shows you that growth is under more pressure. This, of course, in this year of historic backup of rates, the inflation fears there weighing, because it means that growth tech look less attractive relative to valuation. And that's showing from a sector standpoint. As liquidity is being drained from the system with the Fed raising rates and QT, you can see that more than 50% of the S&P 500 members within discretionary, think Amazon and Tesla, communication services, Alphabet and Facebook, and then tech, think Apple, and of course, close to a bear market, that one down more than 30%. Even the financials, with rates up so much, of course, not today and over the last couple of days, even the financials down sharply. More than 37% of the financials down more than 30%. As for rates, let's take a look at the yield curve since the last Fed meeting. It's really pretty extraordinary because, of course, you had that steepening of court at first, but now, John, you have it coming back in, and of course it did flatten, invert in early April. The S&P 500 is said to be a forecasting tool out 6 months. Does that mean a recession? And of course, does it look like the Fed may have to be more hawkish than is priced in currently?
Abby, thank you. That banks trade you mentioned has caught a lot of people wrong-footed. Here are the moves year to date. JP Morgan down 25%, Goldman down 21%, Morgan Stanley down almost 20%, Citigroup down 21%, Bank of America down by more than 20%. Bob Dole, that trade has not worked. Is there reason to believe it's going to work anytime soon?
If we don't have a recession, that's the big proviso necessary. Look, the yield curve, where interest rates are, quality of the balance sheets, cheapness of the stocks. That's why people thought banks and financials in general would be good, me included. But now this talk of recessions crept in, and that's caused people to say, I'll sell and I'll ask questions later. If we can get through this year without a recession, we will get a trade in the financials.
Well, they keep selling. Futures down again on the S&P, on the NASDAQ too. Banks have really struggled. The financials down 15% year to date. Some of those big names on Wall Street, though, hit a whole lot harder. Subadra, your call on this recession story. Where are you and the team at SocGen now?
I think it's too soon to really call for a recession. We're just not seeing any of the classic signs that you typically tend to see during a recession, a tightening of corporate profit margins or an inventory buildup. So for the most part, I think it's really too soon to really start seeing substantial signs of a recession. But, the curve is going to continue to flatten. We did see the curve briefly invert. About a month and a half ago. I think that there's more room for the curve to continue to flatten because the front end is going to be pegged to the Fed, and a lot of the sort of flight to quality you're seeing is going to play out in the long end of the curve. So we are looking for sort of nascent signs of a slowdown in the economy. I think it's too early to call a recession.
Subadra, too early, though, to call a top in 10-year yields because it feels like that's what you're doing.
It does feel a little bit toppy. I think you're starting to see some profit taking in short positions in tens. Like I said earlier, I think I'm looking at the correlations between stocks and bonds. The move towards higher yields is not going to be a straight line, as we've observed in this cycle. Volatility is extraordinarily high. Liquidity is really sparse as well. So that's leading to some choppy moves in the bond market. But we could see 10-year yields between 2.5% and 3%, at least for the next few, at least for the next quarter or so, and overshoot at time towards 3.25%.
So, Badger, right now, twos are trading where tens are rather trading at where twos were last week. 285 on a 10-year now, 285 on a 2-year last Wednesday. Your 2 years back down to 257. Citi had this to say. They think risks around Fed funds might be tilted to the upside. They say the following: these price increases are very likely reflecting pass-through from higher labour costs and keep risk tilted towards still more hawkish policy outcomes. We continue to expect rate hikes of at least 50 basis points at the next 3 FOMC meetings and possibly beyond. What's the upside risk, Subadra, at the front end for you?
You know, I think the market is very efficiently priced for rate hikes. So to me, I feel like there's, the market's pricing out some of that risk because we've gotten too far too fast. I mean, the market's pricing in for, the Fed funds rate to get to 3.5% by the middle of the year. Now those expectations have been pared back. The 1-year forward, 1-year OIS, which is what we typically track, is close to 3%, not 3.5%. So to me, that sort of scenario makes sense given the fact that there's a potential for a meaningful slowdown in growth, perhaps as early as the second half of this year. So, too much gets priced in and then it gets priced out based on, the broader macroeconomic backdrop. So the price action is not surprising to me.
At the front end this morning, yields lower by 6 or 7 basis points, 257 on a 2-year. Equity futures down about 0.75%. With your movers, let's get you some more with Ed Ludlow.
Good morning, John. We start with Disney. Subscribers better than expected in the quarter, but the macro backdrop made it very difficult. A miss on earnings, a miss on the top line, and analysts cutting price targets. Why? Because management tempered expectations for growth on the Disney Plus platform in the second half of this year. It's tough out there, John, especially in China and Eastern Europe with the war in Ukraine. Nvidia, really interesting name. Semiconductors been under pain, right? This is a stock that trades at 30 times forward earnings. 30 times forward earnings in this environment, down 2.6% in pre-market trading. Apple down 2.5%. Market cap now at a modest $2.3 trillion. But the big take, John, is that with the drop we saw Wednesday, it has now lost its crown as the world's most valuable publicly traded company to Saudi's Aramco, of course, energy and technology just moving in completely opposite directions at the moment. And Coinbase down 8% in pre-market. Let's call it what it is, John. It's a bloodbath. Down 50% over 3 trading sessions. Very disappointing earnings. Massive concern that in a bear market and the flight from crypto we've seen, Coinbase is a platform that needs massive volatility to make any money in the second half this year.
It's a bear market. And in some places in this market, a bubble has burst. Ed, thank you. We'll catch up with you a little bit later. Coming up, President Biden addressing inflation in America.
Inflation is our top economic challenge right now. I'm taking inflation very seriously, and it's my top domestic priority.
The blame game down in D.C. Up next.
Families all across America are hurting because of inflation. Republicans love to attack me as a big spender, as if that's the reason why inflation's gone up. Some of the roots of the inflation are outside of our control, to state the obvious. There are 2 leading causes of inflation: a once-in-a-century pandemic, these supply challenges; a second cause, Mr. Putin's war in Ukraine, the Putin price hike, high gas prices and energy prices because of Putin's invasion. Putin's war has raised food prices as well. We're seeing historic inflation, but there are things we can do. That starts with the Federal Reserve, which plays a primary role in fighting inflation in our country. So the Fed should do its job.
President Biden playing the blame game in Washington with one eye on the Fed, writing the following: I believe we have built a strong economy and a strong labour market, and I agree with what Chairman Powell said last week, that the number one threat to that strength is inflation. I'm confident the Fed will do its job with that in mind. Bloomberg's Anne-Marie joins us now down in Washington. AMH, the blame game continues.
Yeah, and clearly the president is nervous about it. Jonathan, last night, speaking to donors in Chicago, he said everyone is scared as hell. Those were his words when it comes to inflation. So you now see the administration not just talking about the policies long term that they think could help Americans when it comes to higher costs, but actually talking about the fact that they need to go out and explain that their policies are better than the Republican policies. And you're going to see a lot of tension really as we get up to the midterm elections. But the numbers speak for themselves. What we have is energy up almost 14% year on year. Food prices up more than 9%. Now, the administration would like to talk about a very healthy, right now, a tight labor market. You had wage gains, real wages when you strip out inflation. people are not getting those gains. And then, of course, if you have money in the stock market and your 401k, you have the S&P 500 lower, and then gasoline at a record high. This is something Americans feel every single day.
You touched on it. Let's go through some of the numbers here. Utilities in the inflation report yesterday up 13.7% year over year, the most since 2008. You look at shelter costs up 0.5% for a third straight month, the highest since 2005. You mentioned real wages negative for a 13th straight month. And if you're looking at the categories that make up inflation, 60% of categories have seen prices rise more than 5% in the past year. We've heard the president a couple of times, Anne-Marie, over the last couple of days. I get it. He's focused on it. He wants to try and do something about it. Can you talk to me about the Republican strategy going into the midterms? And not for Senator Rick Scott. I want to hear from Senator McConnell. Is it his job now to come up with a plan, or just to wait this out and say nothing?
Well, they kind of have been doing a little bit of both, right? I mean, they almost think that if inflation is so bad, this is what Americans care about. Poll after poll shows this. Then all they can really do is just hammer Democrats, and they're already doing it in terms of the primaries across the country, talking about higher gasoline prices, talking about how things cost a lot more now than they did before the Biden administration came in. Now, obviously, you need to explain a lot of this. The root cause of inflation, even though there's a lot of issues that have maybe exacerbated it, the root cause of inflation was, of course, the once-in-a-lifetime pandemic. So some Republicans are just letting the Democrats do their bidding and their PR for them. But then you have others like Senator Rick Scott who says, well, I have a plan. And now the Democrats are really harnessing that and harping on that and painting it as the entire Republican plan and going after that and saying it's either that, them versus us. And that plan, Jonathan, a lot of Americans, even those the most vulnerable in society and the lowest of incomes, would see taxes go up.
MH, great work as always down in Washington. Thank you. You know the story now, some real wealth destruction. Equities down, crypto hammered, energy prices up, gas prices, where are we now? $4.40 a gallon on average in this country. Some places lower, some places much, much higher. Can the consumer take much more of this? This was TD's Priya Misra on that story.
Wages are not rising as much as inflation. So the consumer right now has got some savings, but is dealing with tighter financial conditions, higher mortgage rates, and the fact that the amount that the consumer is earning or the household sector is actually being eroded every single day when they go to the grocery store, they try and fill their gas tank. So I have to think at some point the consumer starts to struggle.
Is that some point right now? Subadra, still with us. Subadra, you touched on this briefly. Let's build it out a little bit more. I've had a lot of people come on this show over the last 12, 18 months and talk about the strength of the consumer, the strength of household balance sheets. Just how resilient are they going to be, considering everything we've talked about in the first 20 minutes of this show?
I am concerned about how resilient they can be. I mean, coming out of the pandemic, there was savings rates were high, employment was continuing to grow, more jobs were being created. Employment picture is still robust, but like you mentioned, I think that wage gains are not keeping up with the rise in inflation. So real wages are actually negative, and at some point you're going to see a retrenchment coming from the consumer because it's just not sustainable for them to be able to spend as much as they can, given the fact that the inflation picture is much more broad-based. It's of course food as well as energy prices, but a whole slew of consumer goods are going up and staying up in prices. So I think you're going to see that demand destruction come a lot sooner than people expect. Broadly speaking, I think that it might take a few more months, given the fact that we're still continuing to add jobs in the job market. But towards the latter half of the year is when I think you're going to really see that play out in a big way as demand destruction starts to rear its head.
Bob, the equity market has to get in front of this. It anticipates. We know that. It's discounting it right now. It's in the process of doing so. The messy earnings reports are in our future. The guide to lower are in our future. We know all that stuff, Bob. At what point do you look at the price of the story and say it's adjusted fully, it's adjusted enough, we've discounted these risks, I'm comfortable again? What would you look for?
Quality. I want quality in the balance sheet. I want quality in the income statement, predictability of earnings, quality of the management, and I want lower duration. Our bond people teach us lots of good lessons. When interest rates go up, because inflation's going up. You don't want to own long duration bonds. You don't want to own long duration stocks either. Get a little bit of yield, get some dividend growth. They're the kinds of places you can go in these uncertain times where things are weakening.
If you think things are tough in the States, let's talk about Europe and finish there. Subadra, I asked this question of Lisa a little bit early this morning. Allow me to ask it of you. Who do you think's got a tougher job, Chairman Powell or President Lagarde? Because the ECB has a big meeting coming up next month.
Definitely President Lagarde, given the fact that they have such a strong dependence to what's going on in Ukraine and Russia. And, today's headlines make things even harder for them, given the fact that there's a serious concern that they might not have access to energy coming from Russia. And if that were to happen, you're going to see a very, very sharp, deep recession in Europe. So for them, yes, they do want a normalized policy. The market's pricing in 75 basis points of rate hikes for this year. But broadly speaking, I think it's going to be very, very challenging for the ECB. I mean, we heard that from the Bank of England last week, where the committee was extraordinarily divided on policy outcomes, whether they should be raising rates or not doing anything. I think that the ECB is in a much more tougher situation, trying to balance its inflation mandate versus the broader, slowdown in the economy coming from the dependencies with Russia.
Subadra Rajappa alongside Bob Dole, to the both of you on a difficult morning, a difficult few weeks. Thank you. Coming up, the morning calls and later, mounting fears of a US recession. Deutsche Bank says it might be on the horizon. That conversation still ahead with chief US economist Matt Luzzetti. Looking at equity futures this morning, we are about 7 minutes away from the opening bell, with your S&P negative once again, down about 20, and off session lows we're down 0.5%, and more pain in store for the Nasdaq at the opening bell. Your opening bell just moments away. 5 minutes away from the opening bell. Futures down 0.6 on the S&P, down about 1.3% on the Nasdaq 100. More pain in store potentially around the opening bell. That's the price action. Here are your morning calls. First up, Wells Fargo downgrading Ford to underweight from overweight, cutting shares by 2 notches due to tightening supply and surging prices. Piper Sandler downgrading Zoom to neutral, 96 price target, seeing limited upside and challenges to sustainable growth. And finally, Barclays downgrading Beyond Meat to equal weight, expecting margins to remain under pressure after reporting disappointing results. That stock is down by more than 20%. Coming up, preparing for contraction in America. Deutsche Bank's Matt Luzzetti anticipating a mild US recession by the end of next year. That conversation is just around the corner, as is the opening bell. Minutes away, with futures down 0.7% on the S&P. Good morning. .4 seconds away from the opening bell in New York this morning. Good morning. Here's the price action, down 0.8% on the S&P. On the Nasdaq, we are down another 1.5, and on the Russell, we're negative 0.4%. Brutal yesterday, and perhaps more of the same still to come. There's the opening bell. Switch up the board and get to the bond market. Yields lower again. This is for a 4th straight session now that Treasuries have rallied, down another 5 basis points to 286.60. It looked like we were breaking out on Monday morning. We breached 320 briefly. Since then, though, we've backed away. Euro-dollar backed away as well this morning in a big way. Euro-dollar very briefly, a break of 104, a 103 handle, just about 104 now, at 104.10. Negative 1% on that currency pair. And crude, just about holding on to gains, up 1/3 of 1%, a 106 handle on WTI. About 30 seconds into this on the S&P 500, we are negative 0.8%. Consumer discretionary leading the losses, down by 1.6. Information technology down by 1.3. With your movers at the open, here's Abby.
Another rough start here for stocks for sure, John. And you were just mentioning consumer discretionary, that sector down the most, down 1.5%. That has everything to do with Disney. Disney down sharply. This, of course, despite the fact that the company beat subscriber numbers for streaming customers. On the other hand, they're talking about how the second half could be weaker, basically offering a weak guidance, and they're trimming on content production, which could continue to weigh on the future. Coinbase, another brutal day, down 13%. Into today, down 58.7%. The largest crypto exchange is out defending itself, though, saying that bankruptcy is not a concern. Whenever you heard that word, it's definitely a concern for investors seeing that today. Twitter, even a part of the tech wreck, despite the fact that financing potentially led by Apollo could be provided for Elon Musk's bid for the company. And then finally, John, the big one, Apple down 1.75%. I believe at one point here touching a bear market from its December peak, the biggest weighting to the indexes here in the U.S. So, of course, as Apple goes, so go the markets. Will the support here hold or not? Tough call, John.
Yeah, just looking at the high of Apple earlier this year, we're down more than 20% since then. Based on this move, Abby, thank you. What a turnaround for Apple. Shares hovering at a record high near about 6 weeks ago, and now losing its title as the world's most valuable company to Saudi Aramco. Ed Ludlow on the West Coast with more. Morning, Ed.
Yeah, good morning. We are down 20%-ish from that January peak. But what's really astonishing to me is how much of that sell-off has been in the last 7 days or 7 sessions. You think about how long we've been talking about the pressure on tech in the NASDAQ 100. Apple actually held its own for a while. And your last guest was talking about quality of balance sheet, predictability of earnings. There was a time where we were talking about Apple in that context, John. You look at the other mega caps, the sell-off we've seen, Apple's right up there with the wealth destruction you were talking about in your last segment, down $542 billion of value in a market cap context year to date. What is the direction of travel? We acknowledge inflation. We acknowledge the Fed could go higher, and we're trying to position ourselves for a direction of travel. You look at valuations, for example, on the NASDAQ 100, we're trading at around 20 times forward earnings. That's down from the record of 29 times forward earnings in November. But is it enough? You look at Citigroup and strategists led by Robert Buckland, for example, they say stay away from growth, and tech lumped in with that because yields should continue to rise. If yields continue to rise, we do continue to see pressure on the NASDAQ 100. The last point, volatility is very high, John. And in the conversations we're having across programs, how do you play this with volatility where it's at? If you're certain on the direction of travel, what do you do about it?
Ed, looking forward to your coverage through today, sir. Thank you. Ed Ludlow there on the West Coast. Here are the scores about 3 or 4 minutes in. We're down 1% on the S&P on the session, on the NASDAQ down 1.6. On the year to date, the S&P down by 18%, the NASDAQ composite down by 28.6%. Absolutely brutal. With more, here's Candy Lyons.
Well, if only it were limited to just technology stocks, John, but we have seen a lot of things breaking or at least breaking down across speculative assets, and that includes cryptocurrencies. Just take a look at stablecoins, which in theory are supposed to be stable and maintain a one-for-one peg to the U.S. dollar. They are no longer doing so. Instability is now the name of the game, and whether it's a cause or a symptom, Bitcoin has dropped like a stone in recent days, now down the better part of 30% over just the last 2 weeks. We're trading in around 28,000, which is the lowest level going back to the final days of September of 2020. So if you bought Bitcoin on any day in 2021, any day in 2022 thus far and held on to it, you have lost money. Hedge against inflation? Doesn't look like it. And of course, the pain doesn't stop there. What we've seen in crypto is really indicative of what we've seen across risk assets, including equities, with the S&P off 18.5% year to date. But whether it's a hedge fund favorite or a retail favorite like the meme stocks, you're down hard. Meme stocks down about 60% so far this year. And when you look at some of those other high beta plays, it's been pretty much all downhill. With the ARK Innovation ETF, the SPAC index, the IPO index, which tracks newly public companies. All of those peaked more than a year ago, and they are all now back down at levels last seen in 2020. Is it a popping of a bubble? Is it a valuation reset? John, you can call it what you want, but it's been painful.
It's been painful and a little bit more. Kaylee, thank you so much. Things have changed, though, in this market. We've gone from bursting that speculative bubble, let's just call it exactly that in some parts of this equity market, to worrying about a growth scare much more so down the road. And that's why we're seeing this rally in treasuries, perhaps over the last 4 sessions. There are some banks out there calling for a recession. There aren't many that have got that in their base case. Deutsche Bank is one. They write the following: there's little historical precedent for job openings to decline without unemployment rising and a recession occurring. Leading that team, Deutsche Bank's Matt Luzzetti, he joins us now. Matt, you already think that this Powell Fed has delivered what you call a Volcker-esque shock. Some people might say, well, Matt, we've only had 75 basis points of hikes. QT hasn't even started. What do you mean?
Sure. First, thanks so much for having me. I think the important thing is that you can't view the Fed's response simply through what they've done with the Fed funds rate. They have a lot going on. They've announced QT that is going to begin in June. They've guided towards a very aggressive path for the Fed funds rate moving forward. And so we think the Fed's stance and the shift in the Fed stance is best viewed through what we call the shadow rate. And it's essentially a metric that the yield curve tells us about where the actual Fed funds rate may be today, or the effective Fed funds rate is today. And that factors in QT. It factors in how aggressive the Fed has been in their forward guidance. It factors in exactly what the yield curve has been telling us. And when you look at that metric, this shadow rate has risen by nearly 3 percentage points over the past 6 months. You have to go all the way back to 1981 to see a shock that is as big as what we've seen. And I think that context is just important for understanding everything that you just mentioned, the tightening of financial conditions that we're seeing. It is a response to a Fed that has gotten very aggressive for necessary reasons from an inflation perspective, and a Fed that we think will continue to be aggressive here.
Matt, you don't think this ends well. You don't believe in this soft landing talk. Let's talk about what you do believe in, and that's a mild recession. Can you put some numbers on what you and the team do expect from this economy in the next 18 months?
Yeah, so we're actually reasonably constructive in the near term, and we have been reasonably constructive in the near term, expecting consumer spending, particularly in services, to remain resilient, CapEx growth, as we saw in Q1, to be strong, and the labor market to continue to tighten in the near term. And it is that kind of construct of the economic environment that we think will continue to produce price pressures and wage pressures enough that will force the Fed to move to a restrictive stance, and that is the ultimate source of a recession. Our baseline is that the recession doesn't happen until around the end of next year. You get negative growth in the second half of next year. We call it a mild one. You could think of it as moderate, with the unemployment rate rising by 1.7 percentage points or so. But I think importantly, financial conditions are tightening a lot here. If the Fed moves more aggressively, if they continue to tighten a lot more aggressively, there are risks that the recession could come even a bit earlier than we anticipate.
Well, Matt, let's build on that. You said one thing, and we'll get to financial conditions in a moment. You said consumer spending in the near term would remain resilient. Some people listening to that, looking at the price action on the screen, the wealth destruction in equities, in crypto, the high utility prices, energy prices, the higher mortgage costs, mortgage rates higher. Matt, they're going to be asking a question of you. How on earth does consumer spending remain resilient in the face of all of that?
Absolutely, and it is a good question. We're seeing a lot of headwinds, all the ones that you just mentioned. I think there are a few reasons. One, the services sector is key to this recovery. It's still well below pre-COVID trends, and I think it has very good momentum. And we saw it with airfares prices yesterday, up 18% month on month in the prior month, driven by significant demand that is there. We still see areas that are supply constrained, autos and housing. And so even if you have some demand destruction, as long as supply constraints ease a bit there, you will see consumer spending pick up. And I think it's just important to note that the S&P 500 equities are not necessarily indicative of what the real economy is. They tend to be far more focused on the goods sector. And that's an area where we expect consumer spending to decline in the goods sector outside of autos. And so I think it is reflecting a reality of, particularly in the goods sector, which is well above trend, the decline in consumption that needs to take place there. Our base case is that'll be offset by a strong services sector over the next several quarters.
The Fed puts in retirement. We're all on board with that. That is a consensus view. That's part of the reason we see some of the price action on the screen this morning again, with the S&P down by 1.4%, the Nasdaq down by another 2 percentage points. Matt, what do you believe, as an economist, would bring that Fed put out of retirement?
Look, I think we're in an environment where if you look at those financial conditions indices, the Bloomberg one, for example, financial conditions look like they did at the end of 2018. That was a period that the Fed did pivot in a more dovish direction, but the backdrop is just very different today. The Fed funds rate at that time was close to 2.5%, what the Fed viewed as neutral. Inflation was not an issue. You didn't have an overheated labor market. And so I think you have a Fed that is committed to get inflation down. Powell noted financial conditions 16 times in his press conference last week, wants tighter financial conditions. And so that will mean we will get them, I think, that it will take a continued tightening of financial conditions in order to get inflation down. What could cause them or allow them to back off? It'd be progress on the inflation front, progress on loosening the labor market. But until that happens, I don't think you have a Fed that is going to move less aggressively or sound less hawkishly here.
And Matt, the essence of your call is you think the Fed has to go further than some people believe. For the people who doubt you, what do you say back to them when you have those client conversations? What does that sound like? What do you say back?
Yeah, I think, when you look at the nature of the inflation that we are seeing, yesterday we had another upside surprise on inflation. We are getting some goods disinflation back, but it is primarily driven by the services sector. It is reflective of a very strong domestic labor market and very strong consumer spending growth, particularly on the services side. And our view is that the Fed needs to get to restrictive in order to tame those demand pressures. Once you believe that that is true, then it must suggest that the unemployment rate likely has to rise, that the labor market has to soften and weaken in order to get wage and price pressures down. And the historical evidence is simply that we don't see the unemployment rate rise by 50 basis points or more without a recession happening. And so we would have to claim that this time is different in all these different macro relationships to believe that this does not end in a recession. I would just add with one final point, which is the economy today is the furthest away from the Fed's targets on the labor market inflation as it's been since the early 1980s. The soft landings that we've had historically look nothing like what today's macro backdrop is. And for that reason, we have a very strong base case that the Fed needs to get to restrictive, and that will ultimately cause a recession.
And Matt, final question. Is this call on the US economy independent of a call of what could happen or may not happen in the European economy, in China as well?
Look, we have to factoring in all these global developments into our view, and financial conditions, likely are tightening more than we had thought at this point, more aggressively, more quickly. There's obviously a lot of geopolitical risks out there that are having multiple effects. It's given a bid to U.S. rates. It's strengthening the U.S. dollar. So all of this is happening through financial conditions. What I would say is we do think that there's a very strong domestic growth momentum here, CapEx, the services sector, the labor market. There will be shocks externally. We don't think in and of themselves they are enough to cause the near-term recession. But the key question will be how much does it tighten financial conditions? How disruptive does that become?
Matt, I enjoy reading the research. Thanks to you and the team for leading some of this coverage. Matt Luzzetti, thank you, of Deutsche Bank. We are about 13 minutes into this session. We're down more than 1% on the S&P on the session on the year. Down by more than 18% on the Nasdaq Composite, touching the lows we haven't seen since November 2020, down by 1.55%, negative almost 29% on the year now, year to date. Coming up, mortgage rates rising, rents going up, home builders under pressure.
There just are not enough homes for sale. We need home builders to build more homes if you want this supply-demand imbalance to come back.
That conversation up next.
There's just a lot of missing supply, and that's what's driven this huge uptick in home price appreciation over the last 5 or so years. So as mortgage rates have gone up, and they still have further to go, clearly home buyers are gonna have to trade down to slightly lower price points. But most of the data that I've seen around housing still predicts strong housing appreciation. There just are not enough homes for sale. We need home builders to build more homes if you want this supply-demand imbalance to come back.
Rising rates, supply shortages, pressuring the home builders. The index extending declines, falling for a 6th session. Abby has more. Hey, Abby.
Hey, John. Well, you've been all over this story this year as we've seen home builders absolutely plunge. At this point, down about 40%, whether you're talking about Toll, that's a luxury home builder, or if you talk about D.R. Horton, that's an entry-level home builder, down in a huge way this year, taking some of the home improvement stores with them, including Home Depot, down about 31%, and RH Furnishing, luxury furnishing company, down about 49% this year. Now, it's interesting that he was just talking about the supply, because you could make the argument at this point that it could come down to demand, too. If we go into the Bloomberg terminal, there's a tremendous chart here which suggests we are at an inflection point that is more extreme than the one around the housing bubble. What we're looking at in blue here is the existing home sales coming off the recent peak of about 6.7 million homes sold in early January of 2021. And you have mortgage rates, the bank rate, 30-year blended rate, popping up more than 2.5% this year. So you can see it's creating a bigger meeting of the two lines than happened back in around the housing bubble, suggesting, again, that there could be some demand destruction. Another reason to think that could be happening, John, one index of housing affordability, it is going down. That is not good. When this index is around 100, it suggests that the early starter home buyer, the typical buyer, can afford a typical starter home with a 10% down payment. That's not the case anymore, down below 100. So again, it may not just be a supply issue at this point, but the housing picture could come under pressure around demand as well at this point, John.
Abby, awesome. Thank you. Let's talk about a company who knows this business well. Ferguson, ringing the opening bell from the NYSE this morning, the company moving its primary listing structure back to the exchange. The CEO, Kevin Murphy, writing the following. What we're seeing right now on the ground is good bidding activity that supports new residential construction through at least this calendar year. Kevin Murphy joins us right now. Kevin, important day for you and the company. We'll get to that in just a moment. I just want to start with this, and I'm not trying to age you. You've been with the company for a quarter of a century, 25 years. Have you ever seen an economy like this one?
First of all, Jonathan, thank you for having me. I'm a big fan of your work. Great to be with you. And yes, I have not seen this kind of activity, whether it's supply chain chaos, demand, or inflation, in my time with this industry. So it's a unique time.
We're seeing the moves in the rates market, sir. I'd like to know from your perspective whether you're seeing any softness in the residential market from your perspective. What are you seeing?
So we're a pretty balanced company, res, non-res, new construction, RMI, and we're pretty eyes wide open as it relates to what rate increase and house price appreciation can mean to demand. But right now, we're still seeing good, solid demand. We've got an early view into what happens from a residential construction perspective because our underground water, wastewater, and stormwater infrastructure business is the first on the site when the shovels start to turn. That bidding activity, that shipment activity is still quite strong. We're underbuilt by roughly 3.5 million units inside this country. We need 1.5 million units a year to keep pace with the growth, and we're not seeing that slow down. At least not through our lens, call it the end of our fiscal year, end of the calendar year.
Well, that's what I wanted to talk about, Kevin, your visibility into next year. What does it look like? What would you use as a leading indicator? What would give you that kind of clarity?
Yeah, so we look at all the external data points, of course, but really our first lens is that underground activity. We're working hand in hand with utility contractors as well as residential home builders. And from a supply-demand perspective, what we're seeing is a desire to get product on site earlier. And so we're seeing activity on residential new subdivision work where we're having orders being placed, pulled forward a bit, but being placed for things that are going to start December, January. So again, we're eyes wide open as to what this price appreciation interest rate can mean. But right now, the activity is still pretty strong.
Just on the supply side, have things got better, worse, the same? What's your view on that?
Yeah, so it was ubiquitous across every product category, every customer group that we deal with. And although supply chain pressures have eased, and there's a firming up underneath the feet of a lot of our different manufacturers, there are unique points, different areas that are still having some pressure. Places like appliances, HVAC units, and certainly underground piping materials. So it really is a matter of making sure that we use our balance sheet, we use our world-class supply chain, and our guiding of customers to the right products for their job, because this is a project company, really is what sets us apart.
Kevin, I wasn't around when Wolseley first started. That was the 1800s, and I think they were in the sheep shearing business. The company's changed since then. I was around when you were listed in London. I used to follow the name too. It's a big name for you in the company today, a big moment for you. This is where your revenue base is. This is where shareholders want you to be. How important is today? Let's finish there.
Yeah, today was an exciting day, Jonathan. It's great to see a $23 billion great American company come home to the United States, be listed on the New York Stock Exchange. Yeah, it marries up our listing structure with our revenue and our profits, our management team. The most important thing, though, is it gives a little bit of recognition, a little more recognition to the associates that are guiding new construction, repair, remodel every day. They make a big impact. It's time for them to be recognized for the work that they do.
Kevin, great to catch up, buddy. A tough year ahead of us, maybe. Look forward to catching up soon. Kevin Murphy there of Ferguson. Your equity market down about 0.9% on the S&P. On the NASDAQ, we're down by 1.2 on the year. Should we do it again? It's painful, I know. You can cover your ears if you want to. The S&P year to date down 18%. The NASDAQ down 28%. Up next, your trading diary from New York. This is Bloomberg. I think you're familiar with this kind of equity price action now. Top of the pile this morning, we've got the likes of healthcare, the likes of consumer staples. Bottom of the pile, energy, information technology. The NASDAQ down 1.6%, the S&P down by more than 1 full percentage point. That's the price action. Here's your trading diary. Top of the pile, first of all, Secretary Yellen testifying on Capitol Hill. That's at the top of the hour. The Treasury selling $22 billion in 30-year bonds at 1 p.m. Eastern. The University of Michigan Consumer Sentiment Survey out on Friday. Plus, you get a little bit of Fed speaker sprinkle from Kashkari and Mester next week. Look out for U.S. retail sales coming up on Tuesday. From New York City, for our audience worldwide, thank you again for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.